Welcome to the Market Action Podcast for Tuesday, May 7th. Today's story is a busy crowd of initial public offerings led by ride-sharing giant Uber. Hello, this is David Russell for TradeStation. This week is set to be the busiest for initial public offerings in more than 3 years, led by one of the most prominent deals of all time, ride-sharing giant Uber Technologies. Uber's IPO on Friday is expected to raise $8.5 billion, the largest transaction since Chinese tech giant Alibaba in September 2014. It's a lot of money and would make Uber the sixth largest IPO in history, but it's actually less than the San Francisco-based company was hoping for. Last month, its overall valuation was set around $83 billion. Compare that number to the $120 billion figure a lot of pundits were throwing around last October. What happened? Well, a few things explain Uber's shrinking valuation. First, the stock market crash in late 2018, which hurt sentiment toward the technology sector. Second, the United States is nowhere near adopting self-driving cars in large numbers, and without that kind of technology, Uber faces some major cost hurdles. After all, despite presenting itself as a technology company, is it much more than a glorified taxi dispatcher with a need to pay good old-fashioned human drivers? The company hasn't innovated a real way to lower the cost of transportation. If it had, maybe it would be making money, which it's not. For the 3 months ended March 31st, 2019, we expect net loss attributable to Uber Technologies to be between $1 billion and $1.1 billion, the company declared in a prospectus on April 26th. They added that the expected net loss is due to increased loss from operations due to continued investment in our core platform, including increased incentive and promotion spend. In other words, despite being a massive business with millions of customers and thousands of drivers, Uber still isn't making money. Smaller rival Lyft is another part of the story. It went public in late March. There was some initial hype with investment bankers raising the price into the IPO. It proceeded to spike another 23% in the first moments of trading, but then it ran into a wall of selling and ended up about 15% below its deal price. Attention will remain focused on Lyft this afternoon when its first set of quarterly results are due. The reaction to those numbers could say a lot about how investors will respond to Uber's IPO later in the week. An investor's response is what really matters. Don't forget that Uber and Lyft are now in public markets, not the sheltered world of venture capital in Silicon Valley. This is the real world where portfolio managers want to see real profits, or at least a clear path to real profits. Fortunately, there have been many other IPOs in the last year with investors finding promise in their business models, including many that are using technology for real innovation. Some recent names seem to include Zoom Media and PagerDuty. We've highlighted others on our Market Insights blog, and we will keep reporting on them, especially as the cloud computing revolution continues to remake the landscape of American business. In conclusion, investors love IPOs because they provide access to both innovation and new opportunities. Uber may not be the best example of what Silicon Valley can do, but don't let that distract from the real story, which is that we're still in a golden age of innovation and technological breakthroughs. Uber will surely draw some attention back to the entire IPO market, and that could be a good thing because a lot of promising firms have emerged in the last few years. Just don't forget to do your own research and homework. Thanks for listening to the Market Action Podcast. This has been David Russell for TradeStation.
The preceding podcast was for educational purposes only. All of the symbols and trading ideas discussed were for demonstration purposes and not recommendation. Active trading is not suitable for everyone. You can find additional disclosure information on the TradeStation.com website. Thank you for listening.